So I want to stay on the Fed just for a second because you saying that if they cut once, twice, even three times, it doesn't really matter. And I actually think as a trader, I think it's refreshing to hear that the Fed is not the story right now. I really do, because for how many years now we're so held by what the Fed is going to do, what they say, dot plots, and you're just like, dude, I'm over it, right? I mean, because we're just so held by a word in a statement, and how that sends us in a trajectory one way or the other just makes it very difficult. And now the fact that you're saying that it's we have to watch the earnings and we have to see what the expectations are, and we talk about the multiples and the way that people are looking at the market, I think is very, very important to note. But why does the Fed only cutting once, twice, or three times not really matter?
Well, in the same way, the Fed's tightening of monetary policy hasn't really mattered to the real economy over the course of the last couple of years. And it's because the economy isn't particularly sensitive to the short-term interest rate. And that's, that's sort of a longer term conversation to be had around how the economy, the US economy in particular, is restructured after the global financial crisis. Debt growth and credit growth became less meaningful in terms of the driver of the economy. And, debts were meaningfully restructured into essentially long-term debts, refinanced at low interest rates. And there's not that much debt coming due. Now, if you think about it, if you're a household with, you own your car that you bought years ago, you own your house, you have a 2% mortgage, and you're working a job and getting a 5% wage increase year over year. Like, what does the interest rate have to do with anything that you're doing? Like, literally, it has no impact on you, right? Interest rates could be 2%, they could be 5%, they could be 10%. Like, it doesn't make any difference to you, right? Because you're just, in general, taking in incremental income, paying out your mortgage, which is fixed, and then spending out of your income. And that's the story. That's the macroeconomic story. And so in that sense, it doesn't really matter exactly what the Fed does. Now, on the margin, to the extent that they run tighter for monetary policy for longer, that could start to influence the long end of the curve. Although, as I said, by and large, what's priced into the market right now, which is one, depending on the day, one or two cuts through the end of the year and a few cuts into 25, like, it is likely going to be in that ballpark unless there's a meaningful growth contraction. Of course, if there's a meaningful growth contraction, we go back to our conversation about stock. Like, the Fed cutting isn't going to matter. The Fed is going to cut rapidly if earnings contract rapidly. And if earnings don't contract rapidly, the Fed's not going to matter, right? So that's basically the situation that we're in.
Got it. I was thinking of it more from the US inflation outlook. I mean, you recently mentioned on X the importance of not flipping an economic view based on 1 month of data. Wait, Bob, but this is the most important CPI of our lives, right? We heard that for every month, right? But the question is, how do you interpret the recent US inflation data? And do you see it as an outlier, or is this a new trend?
Well, we've certainly gone from a period where inflation was at, depending on what measure you're looking at, something in the 5, 6, 7% range, to something that's closer to the 2 to 3% range. That's basically where we're at right now. And even though, like, we spend a lot of time like squinting, is it like 2.8 or 2.7 or 2.9 or whatever? Like, who cares? Like, it's at some level, it's still a bit elevated. It's a little high for the Fed's preference. Basically, it will remain unless there's some sort of unexpected shock. It will likely continue to be elevated relative to the Fed's preference. And that elevation is the thing that is an important consideration when it comes to the Fed not proactively cutting. I think we came into 2024, a lot of people were essentially trading off of or keying off of Waller's comments that they were going to do an easing in order to contain in order to bring what was perceived as real rates down. And that was essentially, in some ways, you could look at that like a proactive easing, right? Even though, the economy didn't deteriorate, they were going to proactively ease. I think the fact that inflation is stabilized here at a level that is a bit above where their target is, and the Fed's response, even the dot plot, gave some indication, shifting to only one cut rather than two cuts, rather than three cuts in the most recent dot plot, all points in the direction of like, look, inflation is a little too high. We're not going to proactively ease. And so, expect this monetary policy position that we're going to be in, expect it for a long period of time. And honestly, like, you'd be a lot better off just like stop listening to all, certainly stop listening to the Fed, and certainly stop listening to those governors. Like they have no idea what's going on, and they certainly have no idea what future monetary policy is going to be. And so like, you're much better off just not listening to them and just kind of pencil in the Fed. It's like, it's going to be hot, rates will be elevated. They're not going to proactively ease unless growth slows, and just like, and move on. There's other things that are more interesting to be thinking about these days.
I love that you're saying this, Bob, because I think that for so many traders out there and investors, they're trying to read the tea leaves of what the Fed is going to do. And from watching your posts on X, listening to your other interviews, hearing you today, it is not the primary reason the market is moving and doing what it is right now. And I think it's so important because traders get so caught up into what is that macro theme, what is driving this. And you see so many people talking about, well, the Fed's getting ready to cut rates, or, the Fed was raising rates, we couldn't go higher. And all these things, I think, really get into their subconscious. And it's caused a lot of traders to struggle, I think, because it's the environment that we've been in for so long. And to remove ourselves from that, just like it was, I remember when we got into where all we watched was the Fed, I couldn't wait to be out of it. It's like that breaking up with your girlfriend or that divorce from that. You're like, I still feel like there's this connection there, but do I just remove myself from it?